Welcome to today's podcast. Today we are talking to Dr. Daniel Erasmus of Tax Risk Management Services. In today's discussion, Dr. Erasmus will be discussing on how to prepare for a transfer pricing dispute. All documents referred to by Dr. Erasmus in the session are listed below the video, including all relevant web links. Please also take this chance to subscribe to our YouTube channel to ensure that you always receive new and updated discussions like this. Just click on the subscribe button below the video. Without further ado, a warm welcome to Dr. Erasmus.
Welcome to the question and answer session. It appears to me, and this is just what's developing in the world, is the interest and the level of reading and questions. It tells me that many of you with the corporations that you're in or the consulting practices that you're in are facing an onslaught from the revenue authorities around the world. This is very much to be expected at the moment, as transfer pricing is basically seen as low-lying fruit for revenue authorities because of its complexity and because they have such incredible powers in order to not just investigate you as taxpayers or your clients, but also in terms of coming up with assessments very quickly based on their own theory and their own view of things, which oftentimes is far from what it should be. One of the things that I listened to is a very recent talk from TPA Global, which is one of the organizations I belong to. So we're a collection of transfer pricing specialists from around the world. They recently had an online conference, and the lecture I attended will give a very solid overview of what is happening with the extensive exchange of information taking place between state or government levels worldwide, between the banking institutions, the central banks of these countries, and as well as the revenue services, and how that information is going to be used against large corporations such as the ones that you represent, particularly in matters of transfer pricing. And much of the information that's going to be relied upon by these revenue authorities is going to be misinterpreted, and I would say most likely deliberately so that they are in a position to be able to raise these huge telephone number assessments. Having said that, I have the experience of arguing and preparing for tax disputes in transfer pricing matters. I've just been involved in preparing a matter for trial. We were going to go to trial for 6 weeks and have been preparing that since about July. The dispute itself has been in existence for the last 7 years, and we've now gone through 4 series of pleading changes by the revenue authority. So they put forward version 1, which they then changed after the letter of findings to version 2 after accepting part of our letter of objection. Then they introduced a new expert and came up with version 3, and literally 16 business days before the trial was supposed to commence at the end of October, they gave us notification that they were going to substantially change their pleadings, which means they were going to substantially change their grounds of assessment. And literally on the day of the court appearance starting on the 26th of October, we got a copy of their amending pleadings, which is now version 4 and completely changes all 3 other versions that they had put forward. Now, I want you to reflect on that. This client has been preparing at huge expense for a case to have commenced on the 26th of October and has been preparing on this matter for the last 7 years, of which from the middle of July, we've been working with a 10-person team. As you can imagine, it's a very, transfer pricing is very complex. There were over 65,000 pages of discovery documentation that needed to be considered and the relevant portions extracted, let alone getting the experts together and to have them say what they say and prepare this particularly complex case. Their new version changed every other version that they put forward, which means that all the preparation that has taken place over the last 7 years, except maybe for a tiny little portion, has been wasted. Fortunately, because we played strategically our cards correctly, we were able to take a wasted costs order against the Revenue Authority, which means they have to pay for the wasted costs in respect of these very late amendments that were being put forward. And that would also, certainly in the jurisdiction that this is being fought, would include the time that is now required to change our pleadings in meeting their new case. But they did this 16 days before the trial. And how is that possible? Many of you would ask. And here's the problem. So as much as we are tax specialists, when you go into tax dispute resolution, it's extremely important that part of your team are not just the transfer pricing specialists you rely upon in order to put forward that your version is the correct version or the most reasonable version for transfer pricing purposes. It's very important that you have a solid litigation team that understands litigation in the jurisdiction that you are involved in. And this particular jurisdiction, which is probably no different to many others, the courts, so imagine you're now going to appear before a judge and possibly a panel of maybe an accountant or a business member, and these people are not going to be skilled in transfer pricing issues at all. If anything, the moment they start reading the pleadings, they are going to be somewhat confused by the complexity of what's going on. And so if they're now faced with one of the parties, in this case the Revenue Authority, wanting to change their version, they're going to focus on what the law says about changing their version and not looking at the version itself. And the precedence in this particular jurisdiction favors allowing a litigant to change their pleadings even at the 11th hour, providing the prejudice suffered by the other side, which is the taxpayer, can be remedied by a wasted costs order. So if you can demonstrate prejudice beyond that, which is extremely difficult because the prejudice here is we've wasted a lot of time and costs, and if the court grants such a wasted costs order, the court will then grant the opportunity to, in this case, the Revenue Authority, to amend their pleadings. And hence, what has happened, all this time has been spent, and now we are replying to an entirely new set of pleadings, and the matter has now been pushed forward until next year. And we don't know what the court date will be because effectively the pleadings have now been reopened, which means there has to be new discovery, a new pre-trial conference, and then obviously a new opportunity now to respond to that and exchange these pleadings. So a further delay. The advantage to the client, because of the fact that we are experienced litigation lawyers as well, is yes, we were able to obtain the wasted costs order, but in light of these latest amendments, it has put the client in a very, very good position. And one of the challenges that you are going to have in preparing any dispute on transfer pricing is that in most jurisdictions, the onus is on the taxpayer to prove that it does not have to pay the tax that the Revenue Authority has assessed. What that means is the taxpayer has to present its case first in court and prove its particular case on a balance of probabilities. And so that doesn't mean to say that the Revenue Authority doesn't have a responsibility to come up with a solid version as to why they're challenging you there. And there is a lot of jurisprudence that is available, nothing solid, to suggest, and I've even now sort of started developing the theory that when a Revenue Authority tackles the tax transfer pricing documentation for the purposes of raising revised assessments, that the very nature of transfer pricing is such that it always comes down to some sort of range estimation. And so I'm attempting to develop the theory that at best, when revenue does this, it becomes an estimated assessment. I've faced a lot of resistance from seasoned tax practitioners as to why they think it's not an estimated assessment. But the nice thing about developing that theory, and if I am correct, it would then mean that the revenue service must prove the reasonableness of the estimate. And that doesn't apply in all jurisdictions. That only applies in some jurisdictions. So if one can get to a place where you have placed the onus on the revenue authorities in terms of the theory that they are putting forward as being reasonable, then that means they are the ones that have to start in court, and they are the ones that have to then show on a balance of probabilities that what they are doing is correct, which places the taxpayer in a much better position as opposed to having to go first and having to prove that its transfer pricing documentation is reasonable. So as in most of these cases, you are going to have to place reliance on the functional analysis that was done in order to show that the methodology that you've chosen and everything that stacks up behind that methodology is well supported by evidence. And what is that evidence? The evidence isn't just secondhand documentation that's lying around. In many instances, when you're dealing with transfer pricing matters, you're dealing with your headquarters or where the group headquarters is situated in a particular country, and you're interacting with maybe 18, 20, 25, 50 other subsidiary countries around the world. And so a proper functional analysis would have been done with all of those subsidiaries, interviews conducted with various individuals, hopefully, and you would now seek to rely on the evidence that those individuals are going to give. And this is what happens. So when you go into a dispute now, these revenue authorities are looking at years of assessment of 2010, 2011, 2012. Now, I bet you in all of the cases that you would look into, those individuals are no longer working for that company and cannot be tracked down. And so all of a sudden, you're now faced with this huge problem of having to collate all of this first-hand evidence. The individuals that were involved in participating in the functional analyses, the supporting documentation, much of it has gone missing. Systems have changed, people have left, people have died. I mean, so it's a nightmare, and it's extremely difficult for a taxpayer to come up with the evidence that we as litigators want to rely upon in court. And so now we have to look at other ways of doing this. So as much as you might have a fabulous transfer pricing document, ultimately when that gets tested in court, it's going to fall back on the supporting evidence that you have gathered in writing up those reports. Now, I want you just to reflect on that for a minute. Here we have these large institutions that are literally selling cut and paste reports, and I say that with the greatest of respect. And most of the transfer pricing reports that I look at, it's 400 pages of fluff, but there's literally 5 pages that's core to what and central to what is being done for that particular group. And it's what makes up the background information that goes into that core 5 or 10 pages that makes up the core of that transfer pricing documentation. And you really have to ask yourself, where is that supporting evidence? Who has access to it? How are you going to access it? And so when you're compiling these transfer pricing reports and you're now paying these hundreds of thousands to these large institutions to come up with this fluff, that you make sure that behind all of that fluff is hardcore documentation, the interviews that have been conducted with the people when you're doing the function analyses. There's a lot of technology available today. Those interviews should all be recorded, they should all be transcribed, and they should all be signed off by the individuals who were interviewed in giving that information. So that if you cannot access those individuals, at least you can access what was said and still produce as evidence the original recording and a transcript of that recording backing up what was actually done in those interviews. Now, just reflect on that for a moment. That's an exceptional amount of work that needs to be done. And so that needs to be conveyed to these institutions that are conducting these transfer pricing studies. So yes, we're all doing this country by country reporting, and we're having to fill in all of this information. And the reason why we're doing that is because the revenue authorities in the different countries, as I said at the beginning of my talk, are wanting to access this information to nail you hard. That's great. And all of you are spending time in doing that, because it's time consuming, and most of you probably have departments that are underfunded and underutilized because your CFOs don't see you as a profit center and they don't truly appreciate the risks that you are having to deal with. And so all of your time goes into preparing knee-jerk reactions to what the authorities want, when in fact, a lot of your time, and probably the majority of your time, should be going into stacking up the evidence to support your transfer pricing studies that you need to rely upon. So that's great. So I'm telling you what to do in the future. What about the past? Well, you need to do the same. You need to go into the past and you need to now start tracking where you can find the evidence. And there were various ways of doing that. So oftentimes you have a central tax department. The tax department has had email correspondence with all the different subsidiaries on different issues. So one of the things that you can do is go to your computer center, get one of your computer boffins to then look up and extract all the email exchanges, including all of the supporting documents, be they Excel spreadsheets, Word documents, PowerPoint, whatever the case may be, and extract all of that documentation and dump it into a safe place. That's easy enough. And there's a lot of technology available. I use a technology in the United States where you can give them that data dump. So I go back to my case where I'm talking about 65,000 pages. We were able to take that data dump and give it to this organization and explain to them how we wanted it sorted, so that we could now actually, it was all searchable. We could now use keywords and we could search for particular elements in that 65,000 pages of data available and start piecing together the various elements where we needed to find supporting evidence and identify the individuals involved. Of course, a very good starting point is to look at the big institution that has sold you your fluffy report and to find out and get from them in writing what the approach was. Who did they interview? Who did they speak to? What was the process that they followed? And have them certify or set that out in writing so that you can gather all of this evidence and have it in one particular place. It's not going to be as perfect as what I've explained to you, what you need to do into the future, but certainly if you are now tackled by the revenue authorities, you have access to that information. As much as you're going to rely on technical exchanges at the letter of finding stages and the assessment stages, I promise you, when you start going to court, you are going to have to rely on this evidence. What I would like you to do is, I would actually like you to take a look at CFO's journey from staying out of trouble to being fully in control. This is a booklet that I co-authored with TPA Global. So they've taken a very technical approach on how to manage risk, and they've taken the textbook Tax Intelligence contains a detailed version of the 6 habitual mistakes of taxpayers. It's a book that I wrote some time ago, but the principles are still very solid. And what they did is they took those principles and really applied them to what the corporate universe looks like today, and in particular with a sort of slant towards international tax and transfer pricing. So I'm not going to go through every little bit here. This is something really encourage you, especially because where many of you are from a practical point of view, it will help you unpack what you need to be doing in your organizations right now, and as supported by what I've just explained to you as to what the picture looks like in litigation. And let's just take a look at the mistakes. So mistake 1 at the top there is being reactive. Mistake number 2 is a siloed approach. Mistake number 3 is lack of efficient management. Mistake number 4 is lack of sufficient facts. Mistake number 5 is blind faith in internal audits. Mistake number 6 is lack of communication. So now if you just reflect on those blocks, I've spoken to each and every one of them by unpacking to you what litigation ends up looking like in these matters when it comes to transfer pricing, okay? And if you go about your business doing what I've explained to you, the ultimate challenge, which you're all going to face, I can promise you, at some point, all of you, if you're a big corporation, you're going to face a transfer pricing audit. There's no doubt about that. And if you follow these approaches, you're going to be good. Now, you're going to have to convince your CFO, which means you may want to get a copy of this booklet. It's not very long. It's 32 pages with lots of nice glossy diagrams. I know they're all hell of a busy, but this is something that they really need to take a look at in order to be convinced that they need to do what I'm suggesting. And so, the suggestions made by a TPA Global is synchronize your data analytics using software. So I gave you a rudimentary version of what we've done, but there's much more sophisticated software available that helps you extrapolate all the information you need for country by country reporting. So there's a lot of, and you could obviously approach TPA Global. They've looked at a number of different unique systems. Of course, everything has got a cost factor to it, but there is technology available for you to monitor that properly. Adopt a global tax compliance setup, streamline your risk planning provision and ETR impact, align the governance and operational conduct, manage in-house challenges, arrange for clear, effective communication to the stakeholders. The main stakeholder ultimately being your CFO, because if the CFO buys into this process, then you're going to get the budget, you're going to get the staffing, you're going to get what you need in order to make it work. Okay, so I wanted to start with that because that really is going to address a lot of the issues. And then I'm now going to go on to some sort of specific topics. So many of you being in tax dispute environments at the moment, no doubt would have initiated MAP proceedings, a mutual agreement procedure proceedings. So let's say, for instance, you have a dispute between, I'm going to use South Africa and Switzerland. There's a double tax treaty. There's an opportunity for you to approach the competent authority and jurisdiction and to place the responsibility on them to approach the competent authority in Switzerland to address economic double taxation. So normal double taxation is double taxation that is suffered by one taxpayer. Economic double taxation is where you've got your holding company and you've got a subsidiary, and there's double taxation taking place in two different entities. That's known as economic double taxation, all right? So the mutual agreement procedure is created so that the two competent authorities, in this case South Africa and Switzerland, communicate with each other to see how they are going to address this double taxation problem. Because if South Africa is increasing is creating this fictitious income which they are going to ascribe to the South African entity to be taxed on, then an adjustment needs to be made in Switzerland, either by way of deductions or whatever the case may be. Now, there is always a time limit, normally within 3 years from the time that you become aware of the dispute being initiated, for you to initiate the MAP process. And once you've initiated the MAP process, it's up to the competent authority in South Africa to pursue it with Switzerland. And in doing so, the South African authority does not want to share with you what they are telling the Swiss authorities, which is no doubt going to be different to the approach they are taking with you. But if you're able to get hold of the competent authorities' correspondence, it's going to give you insight into a different approach, which is going to impact why they are treating you differently versus what they're prepared to agree to with the Swiss authorities. Now, somebody asked, where does the onus of proof lie there? Well, there is no onus. The competent authority simply has the responsibility to pursue the process and up to a point where they either reach agreement, in which case they'll communicate it to you, or they don't reach agreement, in which case they'll communicate it to you and the MAP process terminates. Where it does have an impact is if you've initiated a MAP process and you're going to the tax court, what takes precedence? Should the tax court matter stand back until the competent authority MAP process has been finalized? My view is you cannot proceed to the tax court in respect of those two jurisdictions. You might be able to in respect of the other jurisdictions that are the subject matter of the transfer pricing issue, but in certainly the South Africa-Switzerland arrangement, until the competent authorities have either reached agreement or not. And it would be appropriate to ask the court to stay proceedings insofar as that adjustment goes. Now, some of the revenue authorities don't agree with that. It's an open-ended question, and it is something that will be litigated. And certainly if our matter proceeds to court next year, it is something that we will be arguing vociferously supporting the theory that the MAP process must first run its course before the tax court process runs its course. Now, attached to that, slight umbilical cord, part of my lectures were to introduce you to the whole concept of discriminatory clauses between different treaties, the most favored nation clauses. So I want to take you into the heart of it. At the World Trade, we have two institutions in the world that have memberships by most countries in the world. One is the World Trade Organization, the other one is United Nations. So both, not all of us are members of the OECD. Many of us are mere observers, but many of us who are observers nevertheless will accept what the OECD says by way of guidance. So South Africa is a classic example. South Africa has a specific practice note that addresses its transfer pricing provision, and it specifically says, in the absence of anything in the transfer pricing provision and in the absence of anything in this practice note, you must deflect to the OECD transfer pricing guidelines. And by inference, it means the latest version, which currently is the 2017 version. And remember, the OECD transfer pricing guidelines are ambulatory in nature, which means they're ever changing. Not in the sense that there are major principles changing, but they are developing and evolving and refining certain elements. And you would always deflect to the most recent version or take into account any draft discussions that are taking place. Now, they are not compulsory for the most part. They are guidance of nature, but in common law jurisdictions, you have the legitimate expectations doctrine. And to the extent that the revenue authorities have created the impression that they are going to follow what the OECD guidelines say, you have the opportunity of developing an argument around the legitimate expectations doctrine, which is complex, but the opportunity exists to compel them to follow that particular guidance in certain instances. Now, let's move to the World Trade Organization. So most people think the World Trade Organization has got to do only with customs and excise issues. No, it's about world trade. It's about making sure that the world trade environment is a neutral field, despite the fact that we have all these different states with different domestic legislation, and then there's this entire body of international law. And unfortunately, international law does not play a very big role amongst most international tax specialists. The body of international law out there is massive, and it covers so many different elements. One of them, and one of the key elements, is international tax, and it has an absolute impact on the way in which international tax should be applied in each domestic jurisdiction, taking into account to what extent international law has created what we call peremptory provisions. So the body of international law out of there that has created a solid body that is binding on all states, all nation states worldwide, is similar to having an international constitution. So there isn't this one big document called an international constitution, but if there isn't an international peremptory provision, it is absolutely binding on every single nation state. Now, in some instances, it's because we've all become members of the World Trade Organization, or most of us are members of the United Nations. But in many instances, some of that body of law has transcended into the international body of common law. And so common law is something that doesn't appear in a particular treaty, but it is nevertheless binding on nation states. And there's a huge body of law that supports that interpretation. But let's take a look now at the World Trade Organization and how this impacts particularly a situation where I've now given the example of South Africa and Switzerland having a double tax treaty. But let's say now South Africa and another country doesn't have a double tax treaty, and the outcome between Switzerland and South Africa is great. The competent authorities reach this nice settlement. The taxpayer is happy about the split, but then the revenue authority in South Africa vis-a-vis another country doesn't apply the same thing. So what remedies are available to you? So here I've got the general agreement on trade in services. So you get trade in goods, and I'm looking at the general agreement in trade in services. You need to go and do the reading and think about this. It's very much, there's a lot of dispute resolution around tax issues, but nothing specific to transfer pricing. And so I'm attempting to develop a body of law and interpretation and interest in taking advantage of these principles and applying it to transfer pricing disputes where we have a situation such as I've just described to you. Now look at this. Services includes any service in any sector except services supplied in the exercise of governmental authority. Now each member, so most favored nation, each member shall accord immediately and unconditionally to service and service supplies of any other member treatment no less favorable than it accords to like services and service supplies of any other country. Okay, so it's a very broad definition. And if we go down and we then look at some of the exceptions, so I just wanted to highlight, subject to the requirements that such measures are not applied in a manner which would constitute a means of arbitrary or unjustifiable discrimination between countries. Anything that's, and then it says, the agreement shall be construed to prevent the adoption or enforcement by any members of measures inconsistent with Article 17, provided that the difference in treatment is aimed at ensuring the equitable or effective imposition or collection of direct taxes in respect of services or service suppliers of other members. And if we go down to 17, what does that say? So I'm just highlighting the key clauses. You would take a look at that, and you would look at this particular clause 17, and then you would unpack that and see to what extent you could rely on these clauses to support an argument that the difference of treatment between South Africa and Switzerland and South Africa and another country where there isn't a DTA, that differential, that discrimination might give rise to an opportunity to take advantage of the goods, the general agreement on trade services, to the extent that that discrimination can be exposed. Now, the difficulty with this is there's no precedence, as I've said, in applying this to transfer pricing matters. So it's something that needs to be developed and looked at, number one. Number two, you as an individual, company, corporation, cannot go and implement this. The process is you have to go to your local government and you have to convince them to create a dispute against the other country in order to expose the discrimination. So in my example, it would be South Africa imposing this tax. So let's say the other country is, for argument's sake, Rwanda. There is a double tax treaty with Rwanda, but anyway, Rwanda. You would have to go to Rwanda, and you would have to get the Rwandan government to initiate this dispute process against South Africa. So that makes it very difficult. And I've had experience in doing this between South Africa and the United States. What you'd have to do here is make a presentation to the Rwandan authorities and convince them to raise a dispute at the World Trade Organization level against South Africa to eliminate this particular discrimination that exists. And that's no easy feat. And I was just saying to you, we attempted that between the United States and South Africa, not on a transfer pricing matter, but on another tax-related matter with another piece of another international treaty, which I'm going to address in a minute. And the American authorities were, it's not enough money, we don't feel like it. And so we weren't successful in getting them to represent and to put forward a case on behalf of the corporation. So that's unfortunately the hoop that you have to jump through there. Now, the other advantage, going to the broader spectrum of international tax, and I've posted this particular art. Well, the starting point is the article written by Pijl. Excellent article. And I've highlighted state responsibility is an important issue in international law. The purpose of this article is to put the international law issue of state responsibility in taxation matters in the right context. This is mentioned because international tax law is traditionally excluded from international law handbooks and periodicals. The Permanent Court of International Justice in 1927, which was our factory judgment, found state responsibility to be customary law. In other words, customary international law. The reparation aspect of state responsibility makes international law more difficult. State responsibility does not stop with the recognition of a breach, but attaches financial and other consequences to wrongful behavior. And so it goes on. And so I'm not going to read the whole article, but the gist of it is, once there is this peremptory provision in international law, it's binding on all nation states, everyone, okay? And it doesn't matter that the highest court in that country might come to a particular conclusion. If that conclusion is contrary to the peremptory international customary legal provision that exists, then you can, if you're the corporation in a country that's being offended by this, you again have to go to the powers that be in that state, convince them that you're being offended, and that country can then initiate proceedings, state responsibility proceedings against the offending country. And despite what their legislation says, despite what the highest court has ruled, in fact, you have to go all the way to the highest court to exhaust your remedies, and only then can you initiate this process. You can then, for instance, address discriminatory tax provisions or issues or situations by initiating the state responsibility process. Now, this is the one that I attempted to do between the United States and South Africa. The US just thought, it's a Mickey Mouse sum of money. We don't want to waste our time with this. And unfortunately, we couldn't get that to go further. So these are extraneous rights that are available to you at corporate level, but unfortunately, you have to engage your state where you are the offended party, the offended corporation, and you need to convince them to then take up this fight on your behalf. But these principles exist, and unfortunately, they are just not well known in the arena of international tax, which is why I introduced these concepts. And I see that for the first time in many years, I see you guys are asking a lot of questions around this, and that's good, because the more get involved in this and think about this, the bigger the opportunity to develop this body of law and to challenge these discriminatory approaches that are being taken by the revenue authorities. All right, I think that's enough said on that. There were a number of questions raised regarding, with COVID-19, how does that influence comparability factors and so on and so forth. I basically pulled a number of articles, and there's some very good guidance that's been written on this. I'm not going to lecture you on it. I'm going to refer you to the great guideline drafted by Baker McKenzie with Bloomberg Tax and Accounting, and really gives a superb breakdown on the various elements of COVID-19 and how it's impacted transfer pricing and the issue of comparability. I would ask you please to take, this was very recently drafted. I would ask you please to read through that, and that should address some of the issues that some of you have raised around comparability issues and the impact of COVID-19. Of course, comparability is going to be impacted on many, many different levels. So take a look at this particular document, but please take cognizance of my initial portion of this lecture. It is so important for you to develop that level of detail. I cannot underemphasize it. Thanks, everyone.
Once again, thank you, Dr. Erasmus, for this insightful session. I would like to point out that this topic is dealt with in detail in the IITF's Postgraduate Diploma in Transfer Pricing. The link to the course and all documents mentioned in the session are listed below the video for your convenience. I remind you to also subscribe to this channel by clicking on the subscribe button below. Please contact us if you have any further questions. Thank you for your time, and I hope you have a good day.